Alright guys, today I'm going to go through a tutorial on how to use Tastyworks. So I'm on the online platform. Um, this is the home page, and this is what's going to show you, or what's going to pop up when you first log into your trading platform online. So this basically goes over like the people that are in Tastyworks and their ideas of their trades and what they're doing. They're doing, or what they closed out. Either they bought iron condors or sold their strangles they had, and the results that they've gotten, right? So if you wanted to follow some of these guys, you could follow them. Um, and then here are notable stocks that people are following or that had big moves. Okay, and you could change that here with high option volume. What stocks had high option volumes. Live on Tasty Trade. So Tasty Trade is a show that is put on by Tastyworks that talks about trading options and different types of strategies. Okay, Tasty Trade Futures talks about the futures that they are trading. Okay, stocks with liquidity. Okay, stocks that have a lot of liquidity. So you're going to see stocks here that have a lot of liquidity that you could buy in and out of. Okay. Tasty Trade stocks, stocks that they're trading. Okay, the market. Um, I like to just leave mine on high option volume. I want to see where the volume is coming in. Okay. So if you go to your portfolio, it's going to give you a view like this, and you can have an old table, which I prefer, or you could go to a new table, and it's just a preference on how you want to look at your options and your positions, right? Or you could go to a dashboard, which will give you a whole summary of what's going on, your gain and loss for all your stocks, your current probabilities of in the money or of profit, your balances, your trades, your profitable trades, your unrealized and open profits. Okay, I like to keep mine on the old table. Okay, you have a grid that shows you ranks on implied volatility, earnings dates, IV rank, the net change, percentage change, and the net change. I like to keep mine implied volatility because I want to see, all right, which one of my what are the top implied volatility stocks? Okay, because if implied volatility is high, like here Tesla has a 92, right? 92 implied volatility. That's really high. That means the options I'm gonna be buying for Tesla. They're gonna be very expensive because they have a 92 percent implied volatility. So that's really, really high. Okay, you want to buy stocks that are lower volatility because they're going to be cheaper. If you buy stocks with high volatility, they're going to be more expensive, but they're going to move more, right? In the top right hand corner, it says earnings 24. So that means earnings in 24 days. Okay. Netflix has earnings 2 days. Okay. Netflix has an implied volatility of 84. That's pretty high, but that's given because earnings are in 2 days. So you're going to get high implied volatility. Okay. Nvidia has 81% implied volatility. That's pretty high as well. Their earnings are in 25 days. Okay. They had $11.41 move. Netflix had an $18.46 move. Okay, so this gives you a little idea, a little picture. In okay, implied volatility is in the middle, and the rate of change, the earnings in the top right hand corner. Okay, and you could list them in like the earnings date. Okay, so we have what are the soonest earnings. So UAL is going to have earnings, and then Netflix, then Morgan Stanley, J&J, IBM, Goldman Sachs, and it goes on and on and on. Okay, so any of your stocks are going to have earnings soon. This would be a good calendar to go click on, and in your beginning of your day or on the weekends when you start doing your homework. Okay, because if I have McDonald's, I want to be knowing, okay, McDonald's has a 71% implied volatility. It has 9 days to earnings. So, okay, so I know that when I'm going to be buying McDonald's options for the next week or two, I'm going to be paying a higher premium because they have earnings in 9 days. Same thing with Microsoft. And McDonald's has 71 implied volatility, and Microsoft has 83% implied volatility. So those are pretty high. A lot of these stocks have high implied volatilities because earnings are coming up. So they're going to be a little more expensive than usual because they're pricing in earnings, right? Like Google right here. Google has earnings in 11 days and we have 80% implied volatility. It's pretty high. Okay. Boeing here has 61% implied volatility and earnings in 10 days. That's actually pretty low for a stock that has earnings coming up. So I would watch that implied volatility to increase as earnings get closer and closer. Okay. So in order to make a trade, so you go to the trade tab, and then this is going to pop up here. Now you could go to the curve, which is going to give you a little probability. So this red dot right here, this marker, is where the stock price is right now. So Nvidia right now 246.54. So that's where the stock is right now. Now if you want to buy a call, so you could go down either to a strategy, and you could go to option, and then you could go to long call, and then you would be able to buy a call. And so these little lines right here are 1 standard deviation, right? And this is 2 standard deviation. So technically, they say stocks normally stay in their 1 standard deviation move from where they are currently. So essentially, any options that you buy within this range are going to be a lot more expensive than any options priced outside of this 1 standard deviation. Okay, so you want to stay in this range. I usually do 2 in the money or 2 out of the money. So in the money would be 245. So 2 out of the money would be about 250. Okay, and that's for a call. Now if I wanted to buy a put, I'd go to the options right here, and I'd be long a put, and then that would put it right here. So 2 in the money, or I mean, yeah. So 1 in the money, or in the money would be 250 for a put. Now, if I want to go 2 out of the money, it'd be 245. Okay. And you could just drag this around wherever you want it. Or if you don't like this setup, I like this setup because it's very easy on the eyes, and I could see, okay, I could see the dynamics, right? So I have to move up to this point in order to be profitable. Okay, this is where my money starts coming in, right? And if it goes down this way, then I start losing money right away. Okay, and it's very easy to see, and I can move this around as much as I want, right? There is a table where you could go to the table, and a table is more like your traditional table of where you would go on a regular platform and see, okay, I got the strike price right here. I got 12 days expiration. Expiration is 12 days. Okay, these are my strike prices. Okay, here's my ask. Here's my bid. Okay, here's my delta. Okay, delta is the percentage move, or the exact move from every dollar. So if the stock goes up $1, if I buy this 247.50 call, right? Because this side is calls. So if I buy this 247.50 for $8, I would actually get it in the middle between these two. But for simple math, if we bought this for $8 and the stock went up, right now it's 247 or 246.54. If the stock went up to 247.54, my option would increase 51 cents. So it would be $8.51 that it would be worth that I could sell it for. Okay. So that's what delta is important that we want to view. I like to buy my options between a 30 delta and a 70 delta. So within that one standard deviation range, that's where I want to buy my options at. I don't want to buy it past that one standard deviation because stocks don't typically go higher than that standard one deviation. They do, but for you to get that direction right, it's more difficult, right? You're going to be risking a lot more to be making a lot less. Okay. So here's the put sides. So again, the strike prices, the bid, the ask, and the deltas. Okay. And you can move this around wherever you want. Okay. You could sell it, you could buy it. Okay. So I don't want to buy that one. So I want to buy this one. Or say, never mind, I wanna buy this one. Okay, so and I don't want to buy this one no more. I just exit out. Okay, I just click on it again, I exit out. So if I want to buy, I click the ask, right? I click the ask for a buy, and then I will click the bid for a sell. Okay. All right. So say I wanted to buy, say I was bullish on NVIDIA and I wanted to buy a 250 call. Okay. So I say, okay, I want to buy a 250 call. It'll say, what price do you want it at? Okay. So the bid and ask are pretty tight. So I would try to see if I could get it right in the middle at 665. Okay. And it says 1. Let's see, limit day. Okay. Got it. I would want to increase my if I just wanted to buy one, then I would just click it one time. If I want to increase, I go to quantity and I'd start increasing it. So, and that would increase it to 5. I clicked it 5 times. If I want to decrease it, I'll just do it back down. I brought it back down to 1. So increase it. Okay, so now I want 10 contracts. Okay, if I go to review, and it'll tell me, okay, my max profit is infinity because, you know, the stock could go up forever, and my max loss is 6,650. Okay, so I'm going to edit that order. I'm going to come back. I say, okay, that's too much. I'm going to go back, and I'm only going to get 2 options. Okay, are you that? Okay, so my max, it's saying cost me $13.30, and I could get infinite potential, right? Okay, great. Okay, so that's what I'm going to risk, $13.30 for 12 days. Okay, now if I wanted to change this, right? If I wanted more time, I don't want 12 days. So I get there and I say, no, you know, I want more time. So I'll go to expirations and I'll increase that, right? Let me see. Okay. So let me go back to my curve. I like my curve better. Okay, I go to my options, go to long calls. Okay, so I have this one call, 250, 12 days. Okay, I want to increase that. So I go to increase time, and now it gives me 19 days. Okay, well, now maybe I want lower. So I go down, now I have 5 days. Okay, so this is buy to open, 1 contract. I could change it to 2. Okay, October 19th, that's 5 days. I want a little bit more time. I'll go 12 days. I want a little bit more time. I'll go 19 days. Okay. Now I could say, okay, that's what I want. I want 250 calls, 19 days away, 840. I don't like that. That's too high. So I want to do the mid. I want to do the mid right here. So I'm going to decrease that, and I'm going to do 825 or 830. I'm going to try 825 and see if they fill. Okay, so now this is saying it's not liquid, meaning that there's not a lot of supplies there at that stock price. So I might not get filled. Okay, so but I'm going to take that risk because I want that 250 option 19 days away at say 830. So I'm going to try 830. It's going to cost me $1,660. Okay. If I like it, I could put send and it will send my order, and I'll own those two options if that price is filled. Okay. And this is for a call, right? If I don't like it, I could double click on it. I could exit out. Okay. Now, if I want to do a put, I could go, okay, long puts. Okay. And I could switch this around. I'm going to buy a 245 put. I want 19 days, and I want to buy two of those, and I want to buy it at 910 because that's the mid. This is the mid. Okay, so since it's 19 days out, I'm going to pay 910. Okay, I could look at right here. I got my delta, it's 88, which is great. Theta, negative 47, so that's half of my delta. Okay, IV rank is 81, so it's a little expensive. Okay, my max profit 47,000. That's if the stock goes to zero, which I don't think it's gonna do. So that's not likely. My max loss is 1820. That is likely. Okay, so I see my probability in the money is 35%. So I like it. If I like it, if I think the stock's going down, 245 put, 19 days. Okay, review. Okay, it's gonna cost me 1820. Okay, all right, my buying power will be reduced by 1822 because of the transaction fees. Say, okay, great. It's gonna cost me $2.27 to put on this trade. All right, I'm gonna push send order because I like it. All right, and that's how you do the put, and that's how you do the call. Now, if you wanted to do, say, a strategy, so like a vertical call or a vertical put. So if you want to do a vertical long call, then you could do this. You could have this spread right here. This here is a $5 spread, which you would get. You would pay $263 for this one contract. So if you were bullish, you could use this, move the strikes here, and it'll move both of them one over. So instead of dragging both one over, you could just grab the strikes right here, and you can move it over. Okay. So move that over. So you got 250 call, 255 call. So you're going to pay $223, right? So your max loss is $223. Your max profit is $277, and that's if the stock goes beyond your 255, right? You'll get a max $277 and you're risking $223. Now we could increase that, right? We could increase those calls and say we want to buy 3. Okay, now we're going to be risking $669 and our max profit would be $831. Okay, so that's if we're going to buy a vertical call, right? So we're bullish on the stock, but we don't want to pay $1,800 for it. Okay, so we're going to buy a vertical, and you can only do this if you have margin. If you have cash accounts, you cannot do this because it requires margin to do vertical spreads. Okay, so it's going to cost you $669 to put the trade on, and it's gonna bring you a max profit of $831. Usually on vertical spreads, you want to take profit when you have half of this. So about $400 you would want to take profit, okay? And if you take profit at $400, you made a pretty good profit, right? Okay, so that's going to cost you $675 after fees, and it'll tell you right here, okay, estimated result of buying power, it's going to cost you $675.82, okay? So this is a vertical call if you wanted to be bullish on the stock for 12 days, but you also wanted to limit your risk and your exposure, okay? But you also limit your profits, okay? Same thing goes for a vertical put spread, if you wanted to do a vertical long put, okay, you would go, okay, so 2 out of the money, 2 in the money, so 245 put and 240. If you think it's going lower, okay, you'll see, all right, I got a $5 spread here, 240, 245. It's going to cost me 183, so it's cheaper, right? So it's only going to cost me $183, and my max profit is 317. Now, why is that? It's because the implied volatility is so high, right? The IV rank is 81. Okay, it's very high. Okay, so that's why your options, this one that you're buying and this one that you're selling, this one's expensive. So there's a lot of demand. So when there's a lot of demand for a certain option, the price is going to be a little higher. Okay. All right. So that's going to be that. If you wanted to increase it, you go to quantity, and you increase it, and it'll tell you, all right, so now if you buy 3, you're going to be risking 549, and your max profit is 951, or half of that would essentially be like around 450, right? About 475, okay? 475, that would be your max profit. And if you get 475 out of that, out of only risking 550, then that's a nice gain, okay? And this is a long put spread, okay? Now, if you wanted to sell any options, these are buying puts, and the last one was buying calls. Now, if you wanted to sell some options, right? You would go to vertical, okay, and say you were bullish on the video and you want to be a short put vertical. You go here, okay, and then if you were bullish, the video is 246, okay, so you would want to sell an option 2 out and 3 out. So this is a tighter spread, right? This is 250 and 250, 250. So that 250, 250 is only a $2.50 spread between these two, okay? So your profit's going to be a lot smaller, but your risk is going to be a lot smaller as well. So you're only going to be risking $110 to make $140. Now, if I take this one out, and I want to move this one more out, so now I'm $5 spread. That's going to give me more profit, but it's also going to give me more risk. So max loss is 212 and my max profit is 288. Okay, and that's if I'm selling a put spread. If I'm bullish and I want to sell a put spread, right? So my max loss is 212, max profit is 288. Okay, I could increase that. So I want to sell 3. So my max loss is 636, and my max profit is 864. If we take half of that, it's going to be $430, right? 432 bucks. Okay, and that's a nice gain if we get $432, only risking 636. Okay, and we have 12 days for this to work out. We have 12 days for it to go in our direction. And if it doesn't, this is our max loss, right? And if it doesn't, and we see that it's not doing that, we can also take out this, we could buy this back before this expires, and we could limit our losses to say $200 or $300, okay? All right, so this is how you buy calls, puts, vertical calls, vertical puts, and this is how you sell vertical put spread. And if you want to sell a vertical call spread, then you go to strategies, you go to vertical, you go to short calls, you go here and say you're bearish on the video and you think the video is going to go down. Well, you'll have a vertical call spread here, and you want to go, if you think it is going to go down, you go here. Okay, this again is a tight spread. It's only a $2.50 spread, so you're only going to get $1.50. You're going to get $1.50 max profit, and you're risking 102, right? So let's open this up a little bit and take it one more out for even 5. So now you're going to be risking $187 to make $313. Okay, so these spreads are a lot more profitable right now because the IV rank is so high. So it's more expensive to buy these options. So that's why when you're selling them, you're going to get a lot more money than you're risking, because they're willing to pay you more, because Nvidia has high volatility. That means it's making big moves right now. Okay, so essentially, it limits your risk when you're buying high, or when you're selling high volatility options. Okay, all right. So that's how you buy a call. Okay, let's go over real quick one more time. So buying a call, you go here, choose strategy, option, long call. Okay, long call. You choose the strike, 255, 252, 50, 250. Okay, whichever one you want. If you want more details, double click on it and it'll tell you, okay, here's the delta, here's the vega, here's the theta. Okay, here's the bid, here's the ask. Okay, here's the strike, here's the call, here's the date. Okay, this is how you're buying to open, and then how many contracts. You could change that. Okay, you could change this here. You could buy to close, which if you already have the option, you could close it. This you could sell to open, which means, you know, if you're going to want to do a sell a vertical put spread or a vertical call spread, you could sell to open here. And if you already own one of those, you could sell to close right there. Okay, so since we don't own anything, we'd be buying to open right here. Okay, we could delete this right here, or we could just push done, and this is what we have, and we could change the price right here. Okay, so we always want to get the mid, right? And if the mid isn't a number we could choose, we want to get as close as possible to that. So 545 or 540, depending on what, if you think it's going to pop up or pop down a little bit, that's what you would want to do. Okay, the cheaper, the better for you, but you also don't want to miss it. Okay, especially if you're right on the direction. Okay, so if you don't want to go down to strategies and come down and pick the option and the log call right here, always, you could always just grab this call and drag it, and this will bring up kind of the table from the last example, and it'll show you, okay, November 2nd, November 9th, November 16th, October 19th, October 16th, okay, and then it'll show you the strikes, okay. So if I want to buy October 26th, strike at 260, I'm going to click this one right here. I was at 257.50, but this one, okay, and then I could just move that around to wherever I want it. Okay, if I want 260 call and 12 days, and I want it at the mid, which is 282, I see, okay, so 282, it's any cost me, it could go as high as it wants. Okay, my IV rank is pretty high, so my purchase is going to be a little expensive, but it's okay. I'm bullish on the stock. Okay, review it. Okay, it's going to tell me again, this is my profit, my loss. Okay, and what my buying power is going to be reduced, and what contract and what I'm buying it at, and what's the cost is associated with it. And it's a day. It's enforced for the day, so if it doesn't get filled today, it's any expire. Okay, I push send order, and that is it. Okay, now if I want to look at like the charts or anything, there's a little side button right here that clicks, and then this opens, and it shows you the chart of 1 day, 30 day, and 52 weeks, right? So if I want 52 weeks, I could click on that. 30 day is here, and then 1 day is here. I don't think it's going to show too much, but then you could go with volatility and how the volatility is on this the stock and also the volume. Okay, so it's not showing what the volume is. So I could expand that, and I could go into this charts right here, and I could do trend lines, price lines, channel, and I could say, okay, I want this channel, you know, here, right? And there's my channel. Okay, doesn't give you that many options for drawing tools. You know, trend line. Um, Trend line and channel. So it doesn't give you that many options, but it's a little chart. You know, if you wanted to look at it really quick, or you know, go about, and you would see, okay, so if I want trend line, I want to begin. So I want to begin at its lows, and I'm going to be going off, okay, this lower trend line, and say, okay, so right now it's at its lower trend line. So let's see if that works, and it bounces there. Okay, if I'm bullish on Google, I'll go to my trade tab, or if I'm here and I see Google, I can just click on Google, double click on it, and it'll take me to the trade tab. I was like, all right, I'm bullish on Google, so I want a long call. Okay, I want to say in 12 days it's going to be higher than 1120. Okay, I don't want to pay 31. I want to pay 3010. So I could just type in here as well, 3010, and that will be it. So that would be my IV rank is 80, so that's pretty high. So then it cost me $3,000 for one option expiring in 12 days. So that's pretty pricey, but it could move. So I'm going to take the risk. I order, sell, and then it warns me. It says, be careful, take note that earnings announcement for Google takes place on 12/25, one day before your options are going to expire. So that's why they're expensive, and it's also warning you that it's essentially going to have a big move up or down, so to be cautious there. Okay. All right. So I hope that this little tutorial on Tastyworks helps a lot of you. And you can go to activity, and it'll show you what your working orders are, what your filled orders are, and any miscellaneous orders that weren't filled or rejected. And then you could also go to analyze, and you could go to your previous trades that you did, and you could analyze them, and it will show you what exactly happened, what you ordered. Was it a success? Was it not? And you could have a little trade journal here and type in why it wasn't successful, what you did right, what you did wrong. You know, okay. You go back to your portfolio. You have a list of options here. It'll show your delta, your theta, your trade price of what you bought it for, the mark of where it's at right now, the gain that you have, and today's profit and loss. Okay. All right, and then you could, change that however you want it. Okay, here you could have earnings on the side. You could have notable stocks on the side. And you could have your little brief summary of whatever stock you're looking at. Okay, your working orders. Okay, and then correlation. You have your correlation if you're interested in what the correlations are right now, what's going on. Okay, I like to have it right here on this because I'm just inputting trades. That's it. Okay, so this is how you do your overview on Tastyworks. I hope that helped out a lot of you guys. If you guys have any questions, let me know, and I'll be glad to help. Thanks.